Your cursor hovers over the position size box, not the buy or sell. The open is whipping through the first 1-minute candlesticks. The level 2 is sprinting, and the number you type here determines how loud your heart will beat 2 minutes from now. The setup is clean liquidity sweep below pre-market low, reclaim, higher low against VDU up, offers getting chewed at the figure, but your thumb isn't on the trigger. It's on the size. Too big and you'll feel the screen tunnel in at the first red tick. Too small and you'll watch the move run without you, calculating the money you should have made. A prop-style day trader survives not by finding perfect entries, but by sizing so the next 10 trades exist. You know this, yet your hand still tries to sneak one more 100 shares because this one looks perfect. A green flash in unrealized P&L gives a hit of certainty. A red flash jolts your lungs. And here's the quiet truth before we go further. Most traders lose money, and not because they can't call direction, it's because they miss price risk. This is education, not financial advice. Past patterns don't guarantee the future. Risk management is survival, not bravado. So back to the box. Today we're not just clicking send, we're rebuilding the part of your brain that equates position size with identity and replacing it with a simple, ruthless language. R multiples. You didn't start trading to manage risk, you started to hunt edges. Then the market taught you that edges only matter when your behavior lets them repeat. Mark Douglas called it the probability mindset, the recognition that any single trade is a random outcome in a series, and that certainty is a costume your brain puts on when dopamine surges from a green P&L flicker. That surge recruits overtrading, scales you up after a win, and whispers that your next trade deserves more size because you see it clearly. That's not clarity, that's reinforcement learning. Each quick green tick is a pellet. Each red tick triggers cortisol and a narrowing of attention. Under cortisol, the visual field constricts. You miss the sell wall 3 cents above your entry and confuse noise for order flow intention. The paradox? The trades that truly deserve size usually feel the least comfortable because they require adding risk when your last 2 outcomes were random, not flattering. Come Timon, more analysis does not create more certainty. It creates the illusion of control, which makes size creep up until your stop becomes a suggestion instead of a decision. Now add the prop environment. There's a daily loss limit. There's accountability. There is the scoreboard on the wall. Where your P&L curve is not art, it's permission to come back tomorrow. In that environment, position sizing is not an opinion, it's your air supply. Traders blow up not because they lack setups, but because their size makes normal variance feel like catastrophe. They remove stops when cortisol says, not like this. They average down because adrenaline says, fight. They exit pre-planned winners early because serotonin depletion after a string of reds makes patience feel like danger. Watch a room of scalpers when a news spike hits. Mirror neurons ignite. The hand wants to copy the fastest clicker. Chart pattern hallucination blossoms. Every wick is the wick. Every pullback is the higher low. This is why R multiples matter. When you denominate each trade by R, the initial risk, you stop speaking the market's 100 voices and start speaking one language. 1 R lost is information. 2 R lost is a review. 3 R lost in a day is a walk away. That frame removes the slot machine variable. It also reveals your most expensive bias, the belief that the quality of a setup should change your risk per trade more than the statistical edge you've actually measured. The costly pattern always begins the same way. Green morning. You size up on the next A setup. Only 1.8x your usual because the tape is obvious. It ticks in your favour, you take a partial, and price snaps back to your entry. Your unrealized P&L turns from plus 0.6R to 0.3R in 4 seconds. The discomfort of giving back money feels worse than the original risk, so you move your stop just a little to avoid the sting. That small move, multiplied by the larger position, quietly doubles the emotional cost. Another down tick and you widen once more to let it breathe. Now you've converted a planned 1R into 2.3R, and your frontal cortex is negotiating with your lizard brain. That loss flips the session from playing offense to revenge defense. You take the next B setup too big, needing to make it back. You scalp profits too quickly, 0.3R, 0.4R, because the red echo is still in your ribs. A routine pullback looks like doom. You exit the best trade early and watch it go 3R without you. The paradox tightens. The tighter your stop to protect the day, the bigger the sequence drawdown, because micro stops get harvested by noise, not invalidations. By lunch, you've traded your plan into confetti. At close, you don't remember setups, only amounts. Next morning, you compensate with smaller size on an A+ move, then watch it run, cementing the worst habit in day trading. Sizing from recent P&L, not from predefined risk. Marcus sits in the third row of a prop floor, where the AC hums louder than most voices. He is our risk manager archetype, but he didn't start that way. 2 years ago, his equity curve was a cardiogram jagged, heroic on green days, despairing on red. He read the classics, annotated charts, and still couldn't keep his hand from nudging size after a win. He journaled entries and exits, but not risk. Then a senior in the firm slid a printout onto his desk. R multiples or bust. It wasn't a suggestion, it was a mirror. Marcus rebuilt his station. Left monitor is pure order flow level 2, time and sales, cumulative volume delta. Center is trading view with only price action. VW up, session high-low, liquidity lines, and a 2050 EMA pair. Right monitor is his risk console. Daily loss limit, max R per trade, current day's R distribution, and a live equity drawdown meter that turns amber at 2R, red at 3R. On the desk, a laminated card. Risk defines the trade. He stopped saying shares and started saying R. I lost 1R on the sweep fake, not I lost $420. I took 2.6R on the reclaim, not I made 300. When the morning briefing ends, he does not talk about targets. He reads his heat script aloud. One idea, one risk. If I can't explain the invalidation to a child, I don't size it. His position size comes last, computed from a fixed fraction of his daily loss limit divided by the stop distance in ticks. If the invalidate is too tight for the tape's volatility, he widens the stop and reduces size to hold constant R. If the invalidate is too wide to fit his allowed R, he passes. It feels like discipline. It's actually identity work from Douglas and probability thinking from the zone made physical. I'm calm. Watch Marcus during a drawdown. When he hits 2R on the day, a 5-minute cooling timer triggers. He must stand, stretch, and write one sentence. Which assumption was wrong? Direction, timing, or risk placement? He is not allowed to answer with, the market was manipulated. He checks a small dashboard he coded from his journal. Session expectancy, average R per trade during this hour, current volatility percentile, and win-loss streak triggers. If he's on a 3-loss streak, his next position must be half R, even if the setup screams. Not because he's scared, because streak biology is real. Cortisol residue shrinks patience. Half R buys him seeing. When he is up plus 3R by midday, he does not scale size because I'm hot. He turns on the break-even trap alert, a pop-up reminding him that the next trade can erase 2 hours if he lets winner's dopamine loosen his stop discipline. Risk management is survival is not a slogan on his screen. It's a constraint in his platform. He cannot send an order larger than his max R calculated share size without a second confirmation and a 60-second delay. He engineered his environment to be more disciplined than his impulses. Rewiring position sizing in prop-style day trading starts before the open. Pre-market, script your risk, not your dreams. Step 1. Define R. Choose a fixed fraction of your daily loss limit, say 25% as max loss per trade. If your daily cap is $400, 1 R is equal to $100. Step 2. Translate setups into invalidations, not wishes. Invalidation means the precise price at which the trade thesis is proven wrong by structure. Break of low that created the higher low. VWAP reclaim lost and holds below. Sell wall replenishes and absorbs. Step 3. Compute size mechanically. Shares is equal to R, Juniors. Entry. Stop. No exceptions for A+ feelings. Step 4. Standardize your R ladder. Example. A setup is equal to 1R. A+, measured by back-tested expectancy, is equal to 1.5R. B setup is equal to 0.5R. The grade is earned by data, Tagged screenshots, 50 sample minimum, expectancy in R, standard deviation noted. Step 5. Journal only in R. 5 trades at 0.7, plus 1.2, 1.0, plus a net of 4. Plus 2.1 is not noise, it's your distribution. From that, calculate expectancy E is equal to win rate X average win R, loss rate X average loss R. Your job is to keep average loss 1R, nudge average win above 1R, and protect the denominator number of trades by avoiding emotional churn. Inside the session, adopt the 2-gate rule. Gate 1 is valid setup, all criteria true. Gate 2 is valid state, breath slow, shoulders down, no revenge dialogue, the last trade fully debriefed. Only when both gates are open do you deploy R, use alerts to defend the gates, walk away timers after losses, pulse checks, literally smartwatch, to detect adrenaline. Build a stop hierarchy. Technical stop, the thesis breach, structural buffer, accounting for micro noise, and platform hard stop. The platform stop is not negotiable. It sits on the server, not your mind. If the market knifes your level and slippage turns 1R into 1.4R, you record it as market information, not personal failure, and reduce size for the next trade by the slippage ratio for that symbol in this volatility regime. Make variance your teacher. Expect losing streaks. Design for them. At 3R on the day, you're done. Not because you're weak, but because streak math and brain chemistry conspire. At 6R on the week, you're in sim for the afternoon, reviewing the top 20 screenshots where you cut winners early. You'll mark which exits were dopamine protective, rumors structurally justified. Implement a drawdown ladder. For each 4R of account drawdown, reduce 1R size by 20% until you recover half the drawdown. This keeps the Kelly temptation at bay and respects the market wizard's lesson. Survival precedes compounding. Use a performance table in your journal. Columns for setup code, R risked, R result, reason for exit, target, trail, invalidation, emotion, and state tag, calm, rushed, tilted. Over 30 sessions, you'll see the real leak. Not your entry, your state. When the market is choppy around VBUOP and your tighter stops keep getting nicked, remember the paradox. Tighter stops can create bigger losses. Not in dollars per trade, but in equity trajectory, because a cluster of micro stops triggers tilt, then size changes, then plan abandonment. Solve this by adaptive stop widths tied to current realized volatility, EEG, ATR on your execution timeframe. Keep R constant by shrinking shares as stops widen. You do not give it more room. You keep the same risk and give your idea realistic space. If that makes the trade too small to care, that is the market telling you to wait. More screens rarely add clarity. One clean tape and one clean chart. Beat 5 contradictory timeframes when your pulse is up. There's a reason veteran prop traders sound boring when they talk about risk. Boredom is a moat against adrenaline. Your brain wants hits, your process wants repetition. Before bed, Marcus reads his own stats. Average win R, average loss R, standard deviation of outcomes, maximum consecutive losses, and session expectancy by hour. He rotates his focus some weeks. Execution speed. Others, exit quality. Then slippage control. From Steenbarger's performance lens, he treats the desk like a gym. One muscle group at a time, trained to fatigue with deliberate practice. Then recovered. From the way to trade's systematic ethos, he automates what he can. Fixed orders, tags, alerts. From market wizards, he takes the humility. When the market regime shifts and his go-to-A setup underperforms, he cuts risk and waits for 20 new samples before restoring size. Not heroic, just alive. Picture your transformation. The open ticks, the room buzzes, and you still feel the jolt, but your cursor hovers over size with no tremor. The setup forms, sweep under the session low, fast reclaim, buyer print stacking, VWAP bending. You measure the invalidate 2 cents below the reclaim higher low, and the calculator returns your shares. It's smaller than you want because the stop is wide in this volatility. You nod and accept it. You enter. Price flicks against you, taps your structural buffer, then holds. Your brain requests a stop move to avoid the sting. Your platform ignores you. The bid steps in. You breathe slower, and you trail only when structure changes. First partial at 1R, then you let the third linger into 2.5R, because your plan says one portion must run unless thesis breaks. Later you log the trade, plus 2.1R. You don't feel high, you feel intact. You hit 1R on the next sequence and walk 10 minutes. Not because you're scared, but because your rule says the nervous system gets a reset after any full loss. The desk TV blares about a headline. You don't chase. The clock hits your dead zone when you historically donate P&L. You close the platform and run your R distribution report. It shows a small green day, plum 1.3R, nothing special. You smile because nothing special, compounding, is what pays the desk fee, keeps you within loss limits, and builds the line that matters. The equity curve that bends steadily because you let R, not emotion, define the trade. This is the day you stop auditioning for the market's approval with oversized clicks. This is the day you size the way you breathe measured, repeatable, indifferent to the last inhale. Most traders lose money. Don't be most. Anchor your trading to R. Let probability thinking outrank certainty cravings. Accept that your best trades will sometimes feel wrong at entry, that protecting your downside is what allows your upside to exist, and that surviving drawdowns is not a side quest. It is the game, not financial advice. Just the boring, brutal arithmetic of playing for tomorrow's open.